So we are already significantly overweight the Taiwanese tech sector.
Okay.
We're comfortable with that. Yes, year to date, that has not been a net positive for our performance, but we are long-term investors. We're not traders. We're happy to remain significantly overweight this sector. They all have extremely strong balance sheets. They're extremely well managed, and we do think they will deliver earnings growth and dividend growth in the years ahead.
Sam, how do you feel about China?
We have zero holdings in mainland China. It's 30% of our benchmark, but we are very happy not owning any Chinese names.
Tell me why.
There are several reasons. So when you look back historically, China has been one of the worst performing equity markets in the world over the last 30 years. So in China, GDP growth has not translated into earnings growth for the listed sector, for the listed corporate market, or strong equity market returns, and we don't expect that to change going forward. There clearly are increased geopolitical risks. We can see that on the headlines on an almost daily basis. You have a property market with a big imbalance between supply and demand, and the demographics of China, where you have a population that is shrinking, and shrinking quite quickly, means that you are not going to balance that supply-demand problem for the Chinese property sector anytime soon.
All right, so Sam, for yourself then, it's not so much a case of getting back to buy India, sell China. It's basically don't own China, buy India.
Absolutely. We think investing in China would be taking an unnecessary risk with our clients' money. And we think India, in terms of emerging markets in Asia, is far more attractive than China. So India does have a track record of translating GDP growth into earnings growth and strong equity market performance. It's an economy and a market that's dominated by private sector companies. You have a young, growing population, and we find lots of very high quality companies in India with good balance sheets, strong management teams that we think can grow their earnings and grow their dividends over time.
Okay, Sherry.
Yeah. And again, valuations are looking, well, better than I would say last year as well. What kind of exposure, though, would you like in India at this point? I know you walked us through the reasons why you favor this market, but what are the sectors, what are the names that you would like to own?
So valuations are important, and you're right, India often does look expensive, and we think that India does deserve to trade at the premium it trades at to both the broader Asian market or the broader emerging markets. We own 5 stocks in India. We have 4 companies that are purely exposed to the domestic economy, and we have one IT services company that is more global in its nature. But these 5 companies are all in very different segments. We have a consumer staples company, we have a bank, we have a REIT, and we also have an electricity transmission company. And we think that being exposed to the domestic economy in India reduces the risk from trade tensions if you do have a slowdown or a recession in the US or globally. We're quite confident that these domestic orientated companies in India will be able to continue to deliver strong earnings and dividend growth.